Chapter 17, Investment and Business Brokerage. In this chapter, we're going to talk about the advantages and disadvantages of investing in real estate. We're going to describe tax benefits of real estate investments and the effects of New Jersey Uniform Commercial Code. We're going to learn what that is. And we're basically going to learn a lot of investment lingo, okay, from investor lingo. That's not even real estate related. But when it is related to real estate, we're going to learn about that as well. So, ready, set, go. So, what are the advantages in investing in anything? Well, you want to get some sort of a return on your investment, right? Leverage is when you use someone else's money to do it. Okay. So, using borrowed money is called leverage. And you could also use inflation as a hedge. Remember, I tell you guys all the time that real estate markets are cyclical. Property values go up, they come down. So when property values go up with the market, simply by holding on to it long enough, well, you're using inflation as a hedge to earn money, right? You do nothing but hold on to real estate, the value could increase. Now, what are some of the disadvantages of real estate as the investment vehicle? Well, it's not highly liquid, meaning you can't sell it really quick without taking some sort of a loss. Unlike stocks or bonds where you could buy it now and then in an hour the market could swing and you could sell it and make money. Okay, real estate you typically cannot do that. Okay, it's not that liquid. It requires expert legal and tax information, and there's a high level of risk involved if you don't know what you're doing, because there's a lot of money involved too. All right, so let's do the highlights on that. See, this first part is on page 327, and this over here is 328. This is a screenshot from the last version of book, so these things are split across pages now, so that's why I got the page numbers here where the next part splits. So return includes total income, both direct cash flow and indirect benefits, such as depreciation and depreciation. Investors borrow money to finance real estate purchase with that expectation that if they hold on to it long enough, the asset will yield a greater return than it costs to finance the purchase. And using cash in this way, that's known as leverage. And then the disadvantage is that real estate is not highly liquid over a short period of time. So you're usually not going to buy real estate today and sell it tomorrow and turn a profit. You would have to maybe force some kind of increase in value by doing an improvement at least. You know, real estate markets are not that radical where the values are shifting that quickly. Let me know when you guys got the highlights.
I got it.
Okay. Everybody else good? All right. So, properties held for appreciation using inflation as a hedge, generally expected to increase in value and to show a profit when sold at some future date. Income properties held for producing rental income as well as for profit on the eventual sale. Uh, Cash flow is spendable income after expenses. You want that cash a flowing. Pyramiding through refinancing uh, is a technique where you can keep reinvesting, keep draining the equity out of a property to reinvest it to buy another property. And doing this over and over again, you'll find that all of your properties are highly mortgaged. However, you can find yourself owning millions of dollars worth of real estate in a relatively short period of time. So you basically keep refinancing to drain all the equity out and then using that money as a down payment to buy the next house. Okay. Usually the best way to do this though is, look, you could be starting out with a house that you're going to live in. You could even get an FHA loan or one of these ones that give 100% financing, but they're usually for owner occupants. But that's fine for 1 to 4 families. That could eventually become a investment property for you. So you're living in it now, but you could always move, right? So you're going to live in it, and then when you build up some equity in it, you maybe refinance to a conventional loan, drain out the equity and use it as a down payment. Then you use the FHA program again, this time to buy a different house, maybe another 4 family house that you're going to live in. Okay. Um, but you can only have one FHA loan out at a time. So you can't use FHA as an investor to invest and buy properties with low down payments. Um, Only if you're going to be living in it, and you could only have one FHA. You could only live in one house at a time, so you could have only one FHA loan at a time. Um, FHA, VA, or some other programs you could use. You drain out that equity, you reinvest it as the down payment, buy another house. That's pyramiding through refinancing. And then equity is the difference between the market value and what you owe on the property. So let's highlight cash flow. The object of owning income property is to generate spendable income called cash flow. That's on the top of page, whoop, maybe not, the bottom of page 328. So you get that cash flow, and you rent the property out, you're getting the money from tenants and such. It's generating cash flow after all your expenses. Whatever is yours, that's after the expenses. That's cash flow. All right, so some tax benefits for the sale of your primary residence we've learned about in an earlier chapter. I think it was the end of chapter 11. Could have been 10 or 11. I think 11, chapter 11. So you should always refer people when they ask for how's this going to affect my taxes to their tax professionals, their CPAs, tax attorneys. But both the federal and state governments, we know that they have these programs where you could get that capital gains tax exclusion from their primary residence, up to $250,000 for single filers and up to $500,000 for married couples who file jointly, if you lived in that house for 2 out of the last 5 years. Okay. Remember that if you sell it for less than 2 years, well, the IRS could still give you a tax break on any capital gains uh, if you were forced to sell due to a hardship. And the IRS considers a hardship if you lost your job, if you were forced to sell because you had to transfer because of work, you had to move because of that, forcing that early sale of the home, health reasons, death, divorce, or multiple births. Um, you could use this deduction as often as every 2 years. But remember, this is for your primary residence. Okay. For commercial and straight up investment properties, you can't use this for those. You could only use this for the main property that you have when you sell it. If you sell it at a profit, you pay no taxes on it up to these amounts. So there's another way that you could save money, and it is by doing an exchange. More specifically, in the IRS tax code, there's something known as a 1031 exchange. So let's just highlight all these highlights, and then we'll go to the next slide where I will explain it. Okay, see, highlight, then go to the next slide for explanation. So let's do all these highlights, and let me know when you got them. So, oh, let me let you just finish doing the highlighting, then I'll give the explanations.
I got it.
Okay, everybody good? All right. So the seller must pay income taxes on the profit of any investment property, right? You got a capital gain. Capital gain is taxable income. Okay. So uh, you could get we learned on the previous slide that you could get a capital gains tax exemption from the sale of your primary residences. But what about a straight up investment property that you own? Well, you could do something called a 1031 exchange that allows the investor to defer paying income taxes on the profit of the sale of their investment property if they sell it and reinvest it in another similar like kind investment. That's why they refer to it as a like kind exchange or a tax deferred exchange. Um, what do they call it? Tax deferred exchange. Yep. Or a like kind exchange of uh, so it's a lot of people misunderstand this as you need to find somebody with an investment property that they want to sell, and you get their property and they get yours. No, that's not what it is. That would be next to impossible to find somebody who's willing to take your property here in New Jersey, and you want to buy their investment property, which is down in Florida. You know, um, it doesn't require that. This is a lot easier. It allows you to sell your investment property and then reinvest those funds into another investment property somewhere else. Okay, that's what a like kind exchange is. So you would have to pay income tax on the profit of that sale if you were just to take that money and put it in your pocket. So strict timelines and guidelines, for that matter, must be followed to qualify for this tax deferment, where you would not have to pay any income taxes on the profit of the sale of your first investment property as long as you reinvest it all into another investment property. So, um, you should have a tax attorney or CPA to communicate with the IRS on the special forms that they require you to do it with. You have to notify the IRS that you're going to be doing an exchange at the time of the sale of the current investment property. Then the IRS will give that investor 45 days to find another property that they want to buy as the new investment property. And then you have 180 days in total to close on that new investment property. So it's not 45 days plus 180 days. It's just that they give you 45 days from the time you close on the initial property to find another investment property, with a total of 180 days to close on that deal now. So it's not 45 plus 180. It's just that of that 180, within the first 45 days, you need to find a property and then close on it within 180 days. Follow? Otherwise,
What if
you,
you miss what if you miss it by
there's
I don't know
strict
a few
deadlines.
days?
Doesn't you got to pay the taxes now on that?
No
It
extensions.
That's why this is a strict deadline. There's strict timelines you need to follow. You know, that's why I said you should always have a CPA or tax attorney or somebody involved in there to make you know and make you aware of what the dates are that they have registered so that you do not miss them. You know, because this is very time sensitive. If you do not move things along quickly, you could lose that tax deferment, the benefit of that tax deferment. Um, so it is a strict deadline. Yeah. Now, when the replacement property costs less than an investment property that you sold, the difference in value is known as boot. And boot is loot, and all loot is taxable. It's like the pirate's booty, it's the money. Boot. Boot is loot, and all loot is taxable. So when you sell one investment property and then the new property that you're buying, you're reinvesting in, costs less than the previous one, well, that difference in value is known as boot, and you need to pay taxes on that money that you did not reinvest into the other property. So let's highlight capital gains is profit on an investment. So let's highlight that. And a basis, this is investor lingo we're learning now. A basis is the investor's initial cost for any investment. In this case, we're investing in real estate. So it's their initial cost to buy the real estate. Now, if you got to dump any money into that real estate to try to fix it up at all, you could add your basis, your base price, that's what the basis is, to any improvements, any additional money that you dumped into that property for improvements and such. And then this is known as the adjusted basis. So you calculate your capital gain after you subtract the money that you put into the property to buy it and maybe fix it up. You do not count that. You do not count your capital gain as the sale price for your real estate. You can subtract the cost that you put into it already. And then whatever's in excess of that, that is your capital gain.
Can you explain that again?
Yeah, I will explain it perfectly clear. I'm going to display it on the next slide. Just get these highlights down, and on the very next slide, I'm going to give you a perfectly clear explanation of it. Everybody have these highlights? All right, so here.
Yes.
You have a base price. The basis is your base price. That's your initial cost to buy the real estate. Okay, so you bought a property for $300,000. You dumped another $100,000 into the property to fix it up. So how much are you in now? You're all in. The adjusted basis is $400,000. Okay, that's it. The adjusted basis is just your base price plus any additional money that you put into the property. That's the adjusted basis. And if you were to sell that property now for anything over $400,000, well, that's a capital gain. The amount over the amount of money you put into it. Okay, so they're not going to tax you on money, on your own money that you use to purchase this investment. So for that first $400,000, you're not paying taxes, income tax on it, because that was already your money you put in there. It's not income, right? That's money you laid out. We good? That's all I was explaining on the previous slide. Okay, so it wasn't that difficult, right? Okay, now if you end up selling this property now that you have $400,000 in on, if you sell it for $600,000 and you just cash out that $200,000 profit, you have to pay taxes on $200,000. So if the property appreciates and sells for $600,000 and then there's $200,000 taxable capital gain, if you were to reinvest all that money into another investment property, well, then you wouldn't pay any income taxes because you didn't cash it out and you didn't what they call it realizing the gain. You did not realize the gain yet because you reinvested it. So you don't pay any taxes on it. But any of that money that you do not reinvest, it is a capital gain and you must pay taxes on it. You follow? So this is why a 1031 exchange can be very valuable for investors. It could save you a lot of money in paying income taxes on something if you're just going to reinvest it into another investment. So how about this? If we have a situation like this where you have $600,000 now you sold it for, so there's $200,000 profit there. But if you reinvest all that money and buy another property that's $600,000 or more, there is no gain that you're realizing that you got to pay taxes on. However, if the new property, the new investment property you find is $500,000, there's a $100,000 difference. That difference is the boot. Boot is loot and all loot is taxable. So that's your capital gain. Okay? Everybody understand that? Good? All right. So, depreciation, we learned so far that depreciation is a loss of value due to any cause or condition. Depreciation is a loss of value due to any cause or condition, right? But depreciation is also an accounting concept. So right now we're talking about all kinds of investor lingo. So depreciation is an accounting concept to deduct the cost of an investment and any improvements on that investment for taxation purposes. All right, guys, you want to give me 1 second here? Let me pause this. Okay, so depreciation is not a reflection of the actual loss of value. It's just an accounting concept where um, you could reduce your taxable income. You could reduce your taxable income. So it's not a reflection of the actual value being lost. It's just that the IRS says that, for instance, if you buy a car, that asset has a certain value, and they allow you to, if you're using it for business, for example, you could depreciate the cost to buy that car that you're using for business, or van or truck or what have you, whatever equipment it is. You can depreciate that against your income. However, they don't allow you to do it all in 1 year. You have to depreciate. The IRS has a estimated lifespan of that improvement, that equipment. So the IRS says that you can deduct it over a period of that item's lifespan, estimated lifespan. So for a car, what did they estimate that it'll last for, like 7 years or something like that, 6 or 7 years or whatever it is. So you can deduct the entire cost to purchase that vehicle over the next 6 or 7 years. So you take the total cost and you divide it by the number of years, and then that's how much you could write off against your income. So the same thing applies with real estate. So it's used to reduce the taxable income before the taxes are computed. A property's value cannot be depreciated all at once. The asset has to be depreciated over a period of years. So whatever its life expectancy is, as defined by the IRS. And the IRS defines that residential real estate has a lifespan of 27.5 years, and commercial real estate has a economic lifespan of 39 years. They refer to it as the economic lifespan. So the value of the land cannot be deducted, though. Why not? Because land does not depreciate, only the improvement to the land. So when it comes to real estate depreciation, they will refer to it as the economic lifespan of an improvement. So economic lifespan of an improvement, not the land. Why? Because land does not depreciate. So you got to calculate what the value of the land is, subtract it from the total real estate's value, and then the improvements value can be deducted on your taxes, not the value of the land, because that will never depreciate. Okay? Except in extreme circumstances like contamination, things of that nature. I'll give you some good examples. We'll do a math problem on this because you'll probably get one on exam. So here's the math problem, what it says and what it's going to read like. But I want you guys to write this down here. Highlight this and write next to the title, economic lifespan of an improvement, because that's the wording that they're going to use on exam. they're going to refer to it as the economic lifespan of an improvement. All right, everybody got that? So here's that sample question. It says if a property's estimated value is 500,000 and the land is estimated at 150,000, how much would be depreciated over 3 years if the asset has an economic lifespan of 27 and a half years? So we'll move on to the next slide. I have that in here, but unfortunately this slide has some kind of a problem with its own memory. It just goes step by step and it doesn't allow me to advance it in bits and pieces right here. As you've seen, it just advanced all the way to the next slide. So the trick here is you take the value of the land and subtract it from the total property's value. And that gives you the improvements value. Then you divide it by 20, its economic lifespan in this case is 27 and a half years. And that tells you how much you could depreciate each year. But this specific problem says how much would be depreciated over 3 years. So all you do then is you just times that by 3. Okay, it's a fairly straightforward math problem here. So now, what is this 12,727.27? That means that like if you made $100,000 this year in income, you could subtract $12,727.27 from that. And now when you calculate your taxes, you calculate your taxes on that amount less the 12,727.27, okay, as your income. So you could subtract this by reducing your taxable income before taxes are computed. Make sense? This is a problem they usually give you on exam, and it's pretty straightforward and easy. You just got to remember the little secret there. You got to subtract the value of the land from it. Now, federal tax law limits the deductibility of losses on rental property. The first $25,000 of loss can be used to offset income from any source. Investors must actively participate in the management of the property. They'll call that sweat equity, okay? Because you're the one that's doing the work, whether it's like you're saving money on landscaping by doing the landscaping yourself, instead of hiring a landscaper, or you're doing some other laborious thing that needs to be done at the property instead of hiring someone else to do them. So we refer to that as sweat equity that you put into the property. And it has to have a taxable income of less than $100,000 before the deduction is made. I'll leave that up to your tax experts. We don't need to know any of that stuff for exams. Taxes and tax situations change all the time. Last time President Trump was in office, he tried to he tried to simplify the tax code so that you could put it on a postcard and everybody can do their taxes on a postcard by doing away with all the loopholes for rich people and for people who have this and have that and run businesses. So he tried doing away with it and tried putting in pretty much a flat tax that you could just everybody can file their taxes on a postcard, which would make it a lot easier. But obviously he had a lot of pushback on that because people like especially politicians, they love complicated tax codes because it makes it easier for them to steal your money. You know, it's a lot harder to do when you could track it and you could figure it out yourself because it's pretty simple, right? Yeah, you'll find most politicians will be against anything that simplifies the tax code. But it's pretty interesting from a guy like him because he's already rich and now he's just doing this to try to help out the country. So you trying to simplify your lives, make things a lot easier to figure it out and to make the taxing fairer for everybody. I know we love to hate the rich, so we got to say no, we got to eat the rich. They should pay more in taxes. Well, if you add a flat tax, everybody will pay a flat tax of what their total income is, unless you want to move to the European standard, which now it's based on a usage tax. But then people won't like that either because what if the people who are making more money don't use what you use? Then it's not going to lower your taxes any. So that's the argument all the way around. But either way, a tax credit's a direct reduction in taxes due rather than the deduction from income tax before it is computed. So tax credits are a little bit different than what we just learned about, like this, like the depreciation of your assets. This will reduce your taxable income before you compute your taxes, right? Whereas a tax credit is a direct deduction in what you owe in taxes rather than trying to do the calculations. So it's much more valuable. So here, let's read it a little bit. Tax credit is therefore far greater value. Investors in older buildings, renovations, and low-income housing projects could use tax credits to offset taxes up to $25,000 of other income. Even passive investors can take advantage of tax credits. The maximum income level in which the credits can be taken is also higher. Investors with adjusted gross incomes of up to $200,000 are entitled to the full $25,000 offset, which is reduced by 50 cents for every additional dollar of income and eliminated entirely for incomes above $250,000. So rich people don't get those tax credits. Tax credits have been provided for taxpayers who renovate historic properties as designated by the Department of Interior, and they're listed in the National Register of Historic Landmarks, which New Jersey has a lot of properties like that. A property of historic significance located in the state certified historic district of town. The allowable credit is 20% of the money spent on any renovation. The work must be accomplished in accordance with the Federal Historic Property Guidelines and certified by the Department of Interior. After renovation, the property must be used as a place of business or rented. It cannot be used for personal residence of the person taking the tax credit. There's a credit of 10% on the rehab cost of non-historic buildings placed in service before 1936. I guess they're old buildings, so they seem historic, but they don't have a historic significance about them. So non-historic buildings must be non-residential as well, though. And the law also provides the tax credits ranging from 4 to 9% of each year over a 10-year period for expenditures on new construction and renovation of certain low-income housing. So just need to know tax credit is a direct reduction in taxes due rather than income before it is computed. Okay. You don't need to know about all this kind of details and such. So I have these notes here that taxpayers, let's see, so this is about all the stuff that we read on the previous slide. However, something that they didn't get into much detail was this. Sometimes the government offers tax credits as a stimulus. So the politicians will offer this. This happened when we had the real estate market crash in 2006. Well, to try to stop that continued decline, in 2008, our politicians tried offering a $7,500 tax credit to any buyer that would rush out and buy a home. Because politicians, even though they're the ones that triggered this whole inflated market and the prices going up through their, pressures that they placed on the banks to, make borrowing a lot easier. I already did that whole explanation in those mortgage chapters. Now, when the market started to crash and properties were getting foreclosed on left and right, politicians, in all of their arrogance, figured, well, they could solve this problem of the natural correction of the market, because that's all it is. When the market's crashing, it's actually a correction because it was artificially inflated by actions that the politicians took, imposing pressures on the banks. Now all of these properties were getting foreclosed on, so they figured in all their arrogance that they have a solution that they could put a stop to it. All they got to do is convince enough people to rush out and buy a home. If you got enough people rushing out buying homes, then the values aren't going to be dropping, right? Oh yeah, see, we got the answers. So they try to incentivize people by offering them $7,500 to rush out and buy a home. So now people were thinking, well, hey, we got to be near the bottom by now, right? That $7,500 may be enough cushion for when the property values are dropping to make up. And now may be a good time to buy. But the IRS also put in a little stipulation that you'd have to live in that home for at least 3 years. Otherwise, you need to pay back all that money to the IRS. So politicians, they incentivized all these buyers to rush out and buy homes. So this was in mid-2008 to 2009, and people did rush out and they started buying the homes. Was it in enough volume that it was going to flatten the market, flatten the curve? Come on, we all learned about curves in COVID, right? Flattening the curve, right? So as the market was crashing like this, they figured with the $7,500, it started to flatten the curve a bit, but not totally. The property values were still going down, just not as sharply. Now, at the end of that stimulus program, 2009, what happened? The markets continued correcting themselves, and the property values started to drop like a brick when that $7,500 incentive went away. So politicians, still not learning from their lesson, they said, "Oh, we got an answer to it. We didn't throw enough money at the problem. So what we need to do is we need to offer more money incentive." So they did. They offered this time an $11,000 incentive for people to rush out and buy homes, and they did, and they rushed out. They bought homes. That curve kind of flattened, but it was not 100%. And then once that stimulus went away, that tax credit went away, what happened? Property values continued correcting themselves. So what did politicians manage to accomplish? They accomplished in stretching out how many years it would take for the market to correct itself, instead of just crashing, people getting foreclosed on, being the end of it. Instead, now they stretched it out. They pulled more people who were not in financial hardship into buying real estate and getting involved in this through their incentives. And then when the markets started correcting themselves and crashing again, those people got nervous and sold the houses, did short sales and all kinds of stuff like that. And then they were like, "Whew, I finally got out of it. Ooh, oh my God, dodged the bullet on that one." And then the IRS came knocking on the door and said, "Hey, that stimulus we gave you, that tax credit, you need to pay all that back. Otherwise, face penalties and interest." So what did the politicians do? They just managed to pull more people into financial hardships. Did they fix the problem? No, because the real estate market still corrected itself and still crashed. It has to correct. It has to correct itself. You got to pull back and look at this from an investor's perspective. It's like stocks too. Sometimes they get artificially inflated for some reason, and then they're going to balance themselves out and come right back down to where they should be. Okay, so when the real estate market was artificially inflated when it started crashing. It just took a longer time to get inflated. When it started crashing, it took a long time to correct itself. But it took even longer because the politicians are offered these tax credits. But they also pulled more people now who now are in financial hardships because of that and kind of screwed up their credit because of it too. So you gotta be careful about that. So look, that's why I told you guys about that movie, The Big Short. Did anybody watch that one yet or no? The Big Short? Check it out. We
Yeah,
spoke
it's a
about
good
it
movie.
several times. What's that?
It's a good movie.
Yeah, you watch it? Yeah, it's pretty
Yeah, I
good.
watched it before. It was good.
Yeah, now
Very realistic.
yeah, now
And
if you take the real estate class, you can understand it a little bit better too. Some of what's going on in that whole thing too. You can understand it a little bit better. Try watching it again. Now you can be like, oh, so that's what was going on over there. Yeah, I remember Vic was telling me in class about that. You know, because it's kind of entertaining. It's a good movie, but it's a little bit dry. But if you understand what they're talking about, it makes it a lot more interesting to follow along. Um, Check it out. Okay, so I put together this slide for you guys just to show you a side by side. Which one is more valuable? A tax deduction before taxes are computed or a tax credit after they're computed? So let's just say that somebody's making $100,000 a year on a $100,000 a year income. If you're in a 15% tax bracket, and you have a $15,000 tax deduction available versus a tax credit, which one is more valuable? So we got a $100,000 income with a $15,000 tax deduction. That leaves you with $85,000 of taxable income before you compute your taxes. And if you're in that 15% tax bracket, now you would owe $12,750 in your income taxes at the end of the year if nobody took out any taxes. Now, if you're doing a tax credit, your income's $100,000 a year. You times your tax bracket of 15%, that's $15,000 in income taxes owed. And then you get that credit of $15,000. You pay nothing in income tax. So which one's more valuable, a tax deduction or a tax credit? Tax deductions are calculated before the taxes are, and tax credits are credited after the taxes are computed. Zero, 12,750. Yeah, tax credit clearly more valuable, right? I just want to paint you guys that picture so you could see that there is a difference. Now, a land contract we learned about in chapter 11 and an earlier chapter 2, but chapter 11 is where we really got into it. It's a type of seller financing, also referred to as an installment sales contract, where the owner does not get the buyer doesn't get the deed to the property until the full amount owed is paid. All right, so it's complex tax rules need to be followed, and it's figured on the investor's marginal tax rate. Business organizations are not legally formed entities like syndicates and joint ventures. We know a syndicate is two or more people come together to carry out a business project. We're going to fix and flip a house. You and I, we're going to come together. We're going to form a syndicate to do that, and then we're going to split the profits. We don't need to form a business entity and file it with the government or anything. This is just a project between you and I, okay? Or we could have two or more groups of people come together to carry out that business project. That's the same thing. You don't need to form a business entity that you're paying for to filing fees and get all paperwork done. You don't need to do that. That's just the difference what a syndicate and a joint venture is. Now, a real estate investment syndicate, or REIT, R-E-I, that's a little bit different. That's a syndicate here, is a business venture in which a group of people pool their resources to develop a particular piece of property. That's like the little old ladies sitting around the table, pooling their money together to invest in an apartment building to have some income, okay? That's a real estate investment syndicate. Once again, a syndicate is not is not the formal business entity. All right, so a real estate warning for you about securities. I did speak to you about this in an earlier chapter when I talked about those different business structures, but here we're just going to talk about it again for a second. When seeking money from investors, because you're in the real estate industry, you're helping all these investors find properties and that they're going to fix up and they're going to flip them or hold on to them. But you can see these properties that they buy and you're like, why would you want to buy that as an investment? And then you see what they do with it, and then you're like, ah. So now, like you're seeing and you're learning on how these investors are making money, and now you get a light bulb in your head that's like, I got an idea. I know how to find these properties. I've been finding these properties for these people. How about I buy it myself? Only if I add the money. I got an idea. I'm going to try to put ads out there to try to get investors to invest in my project that I will own. How could I do that? I got to offer them something in return. Yeah, you know what? I'll offer them some of the profit. I'll share the profit with them, right? You offer them some sort of a percentage of the profits, but I'm going to own the property. Be careful. This could be classified as a security. And so this could be classified as a security. You could get into trouble, especially if the investors are not familiar with real estate investing and they lose money. Special licenses are required to deal in securities. If it's real estate that's a security, well, you got to have somebody with a real estate license, that's you, and somebody with the securities license in order to deal in these projects. So the investment must be registered with the FTC, the SEC, and the state of New Jersey, which their blue sky laws cover these topics. Such offerings must have a prospectus prepared, warning the investors, not just trying to sell them into buying into your project that you will own, that you're going to share them all these profits. I mean, you only really sell it if you sell them the upside of it, right? But the thing is, you got to warn them about the downside as well, the possible risk that's involved. That's what a prospectus does. And these specially licensed people who know how to deal in securities know how to prepare these prospectus and register them with the state. The property needs to be registered, and the offering needs to be registered. So such offerings must have a prospectus prepared, warning investors of the possible risks involved with the investment, not just the potential and the upside. Okay. So you can do that. You just need to have somebody involved that, deals in securities. All right. Now, the general partnership, all members share equally in the managerial decisions in a general partnership. They share equally in the profits and losses, but they also can be held liable for any additional debts the business takes on. In a limited partnership, there's always at least one general partner that works the day-to-day activities in the business, and they can be held liable for any additional debts. All the other investors, they're limited partners. They're limited in their liability to the extent that they could only lose their initial investment. Now, a REIT is a real estate investment trust. These are, it must have at least 100%, at least 100 investors. And at least 75% of that trust income must come from real estate as the investment vehicle to be considered a REIT. Now, they even got definitions about who can be an investor, okay? Because the investor has to fall within so much category of having liquid assets and all kinds of crap like that. But either way, REITs are usually buying up entire apartment complexes or commercial buildings and malls and things of that nature, spending tens of millions of dollars on these things. But they're earning money steadily through their rent collections. Okay, usually there's not a big payout on these, so they are good, stable investments for like your retirement plans. Like why invest in in your retirement plans, you could risk in you could post some risk to try to make some money by investing a portion of it into stocks and stuff like that. But then you should have more stable investments like bonds and other things, which are more steady for the payouts. Okay, a REIT would be the same thing. So REIT investors get the same tax advantages as those mutual fund investors. So instead of investing in those safe mutual funds, well, why not invest in real estate? It may pay out a little bit more, but still be safe. So that would be a REIT. Who do REIT investors get the same tax benefits, the same tax advantages as? Mutual fund investors. You need to know that for exam. Okay. You guys already have this highlighted probably from much earlier, right? Everybody got that highlighted in their book, 333?
Yes, we got that.
Okie dokie. Yeah, I don't see anybody saying anything. I don't see anybody nodding their head either. So I just, hello? Did we freeze? Okay. You do not need to have a real estate license to sell a business unless real estate's involved. But look, when selling a business, what kind of property are you selling anyway? Commercial? So we don't prepare the contracts for those things. We could market them to try to sell them, but we don't prepare the actual contracts. So besides title to the real estate or any present lease that needs to be transferred, attorneys would be needed to write up the sale of the business, as well as any assets that business may have, like trade fixtures, stock, inventory, business names, customer lists, goodwill, special rights, such as copyrights, patents, franchise licenses, picket lottery machines, things of that nature. They need to be handled in a certain way. And leave that to the attorneys. We're salespeople. We just do the marketing and find a buyer, and then let the attorneys put the contract together. You guys got this highlight? That you do not need a real estate license to sell a business unless real estate's involved. Look, the business can be for a web development company. I mean, you don't need a real estate license to sell that, right? So when selling a business or buying a business, you need a lot of money to put down. And the business purchase requires cash or personal loans to buy. No mortgage, no real estate involved there, right? So needs to know for exams. So I guess that's important. The Bulk Transfer Act, we should be highlighting on page 334, is designed to protect sellers' creditors. I wrote the word sellers there. The sellers' creditors from the fraud perpetrated by a business owner who sells the business, including the equipment and stock, and then disappears, leaving creditors unpaid. So it's this act, this law, the Bulk Transfer Act, is put in place to protect the seller's creditors from the seller. When the seller is saying, hey, I'm selling my business, all the stock and inventory, machinery, everything is included. Even though I did not pay for it yet, I don't have it all paid off yet, so I don't really own it to sell it. It's not officially mine yet. But I'm going to sell it and say everything's included in the sale of this business. I collect all the money from it, and then I disappear, and I don't pay them off. So I'm basically ripping off my creditors. It's fraud. Now, if you as a real estate agent help them perpetrate that fraud, it's a crime. You help them commit that crime. Right? They committed fraud and you assisted them in that. So the way to prevent that from happening is when selling a business, you have to have the owners make a list of all outstanding debts to creditors and a list of any stock or inventory that's not been paid for in full. And then we need to notify those creditors that the business is for sale and also provide that list to any potential buyers. I usually leave that up to the attorneys to do. but I make sure that it gets done. So, the requirements of the Bulk Transfer Act are designed to protect the interest of the buyers as well as those of the sellers, creditors in the sale of the business. Should be the other way. Protects the seller's creditors as well as the buyers. The buyers are protected as a side effect. Okay, that's like when you buy residential real estate, you get homeowners insurance. Who does homeowners insurance protect? Who does the homeowners insurance that you're required to get if you want to get a loan? You're required to get it by the lender. So who does the homeowners insurance protect?
The actual property, the house,
Well, who is it protecting?
the homeowner.
The lender who's that house that the homeowner has is serving as your collateral for the loan. They want to make sure if that house burns down or gets flooded out or tractor trailer drives through the front of it, that that their collateral is protected. That's why they won't give you the loan unless you show evidence that you paid for and have a homeowner's insurance policy in place showing that that it's payable to your lender. Until you paid off that house, it's going to be payable to your lender. So your homeowner's insurance policy protects the lender. Now, if you have that loan paid off and there's no longer a lender, now that homeowner's insurance policy protects you. Now, during the whole time, even when you have a loan on the house, does it protect the buyer as well? Yeah, it could also protect your belongings and stuff in that house if you list them there on the rider for additional insurance for your personal belongings, right? So homeowner's insurance, does it protect the buyer too? The homeowner? Yeah, but as a side effect, and only for your personal belongings, really. It really protects the lender who that house is serving as collateral for the loan, just so we have an understanding of it. Otherwise, why do I need to get homeowners insurance? Because the lender requires me to if they're going to lend me that money. Okay. So that's where I have my explanations over here. Now, the Bulk Transfer Act is designed to protect the seller's creditors in the sale of a business. It also protects the buyer, but as a side effect, because they should be informed that all the inventory and machinery or tools, the chattel of the property, the personal property of the trade, have not yet been paid for in full, and therefore they could chase after the seller's personal assets to get reimbursed if it turns out later on that they've not been paid for in full. So, for exams, in the sale of a business, what is the law that regulates the sale of business personal property or chattel in the sale of a business?
The Bulk Transfer Act.
The Bulk Transfer Act, correct. Which is actually a part of the Uniform Commercial Code, the UCC. I know we spoke about already the UCC being the Uniform Construction Code, which regulates the construction of buildings. This is the UCC, the Uniform Commercial Code, which regulates the sale of businesses, and more specifically, the Bulk Transfer Act. It prevents that fraud that can be perpetrated by the business owner. All right, so once again, another slide I put together explaining all this from start to finish here. And it regulates the sale of chattel when selling a business. It prevents fraud when the business is sold. And this is what you're required to do. It requires the business seller to make a list of all those outstanding debts to creditors and supply that list to potential buyers and notify the creditors that the business is for sale. And you, as the real estate licensee, must ensure that these disclosures are being made to avoid assisting the seller in committing that crime. So in New Jersey, the Bulk Transfer Act protects who? The seller's creditors but it also protects the buyers. Okay. Anybody want to snap a picture of this slide at all or not? Okay. You get it? You got a clear pic there? All right. And that concludes this chapter. Let's do the key terms to review for chapter 17, and then we'll start 18. There are two key terms to review. Let's do one. Ready? Costs plus improvements minus depreciation. The initial cost plus any improvements minus depreciation. This is all factored into
Adjusted basis.
the adjusted basis. One is A, correct. An increase in value is known as
Appreciation.
appreciation. Two is B. The initial cost to buy real estate is referred to as
Down payment.
Basis.
the basis. Three is C. A document transferring ownership of personal property.
Deed. Title. No, title, no.
To transfer the ownership of personal property, you go
Bill of sale.
bill of sale, correct. You go to the store, you buy some clothes, they give you a receipt, that's your bill of sale. Right?
Yeah, it's the personal property. That's what I missed. I thought it was the real estate.
So, in knowing that now, and a deed is a document that's used to transfer real property, but bill of sale is used to transfer personal property. So, four is D. Extra money or property received by one party in an exchange.
Boot.
Boot. Yeah, when you're doing that 1031 exchange, right? Boot is loot and all loot is taxable. So five is E. You notice a pattern with this key terms to review here so far? All the answers are matching up straight down in row. They forgot to mix them up in this key terms to review right here, this first one here. All right, so a law regulating the sale and financing of business personal property.
Bulk
Bulk
Transfer Act.
Transfer Act.
Yep, six is F, the Bulk Transfer Act. Taxable profit on the difference between the adjusted basis and the net selling price of an asset.
Capital gain.
Capital gain.
8 is G, the capital gain. Money left from, did I say 8 is G or 7 is G, in case I did say that. Sorry. 7 is G. All right, money left from rental income after expenses are paid.
Cash flow.
Cash flow, 8 is H. The next one, 9 is I. It's a horrible definition, so why even bother reading it? It is terrible. Tax-deferred mutual transfers of income property.
Exchange.
10 is J, an exchange, and more specifically, a 1031 exchange, right? And real estate held for rental income is known as an
Income property.
property. 11 is K. All right, key terms 2. They're not all in order, so don't try that. A law regulating transfer of business personal property.
UCC.
The Uniform Commercial Code, UCC. 10 is A. Refinancing property to buy more of it.
Pyramid financing.
Pyramiding. So 4 is B. Direct deduction from income tax due.
Tax credit.
It's a tax credit. 9 is C. A joining together of 2 or more people to carry out a business project. It's not a legally formed business entity.
Syndicate.
Syndicate. 8 is D. D as in David. A group pooling resources to buy real estate. Like those little old ladies around the table.
Real estate investment syndicate.
Correct. 5 is E. A rate at which the investor's top dollar is taxed.
Marginal tax rate.
3 is F. Marginal tax rate. Sale, in which a seller receives the purchase price over a period of years, and they wait for the deed.
Installment
Installment
sale.
sale.
Installment sales contract. 1 is G. Extensive use of borrowed money for purchases.
Leverage.
2 is H, leverage. When you're using someone else's money to invest, right? That's leverage. Fund making real estate investments and selling shares.
Real estate investment trust.
Yep, the REIT. 6 is I. Cash flow plus income tax savings plus appreciation are all examples of
Return.
a return on that investment. That is correct. 7 is J. And that concludes chapter 17. Oh, where did my Zoom controls just go? Come on. There we go.